Hello, I'm Mary Reed, National Director of Qualified Plan Marketing for Alliance Benefit Group Pentegra. We are a third-party administrator of qualified plans and currently administer about 3,500 plans. Our parent company, Pentegra Services, Inc., has been in the pension business for nearly 70 years. Together, our expertise and talented staff helps find solutions for clients. Welcome to our training series for financial professionals. In this series, we will use our expertise to help prepare you to find prospects and write qualified plans from closing to establishing the plan and further administration. Let's begin. Welcome to our session on 401k plans. 401k plans are a kind of defined contribution plan, which means we know how much will be contributed, but the retirement benefit is unknown. We never know, as I'm sure everyone tuned in here knows, how much money you're ultimately going to end up with at the end of the line when you take your money out of your 401k plan. 401k plans are profit sharing plans at their root. It's a profit sharing plan with an added feature for salary deferrals, and so they are subject to the profit sharing limits as well as the additional 401k limits. So the contribution limit is 25% of the total participating payroll. That's how much the employer can put in and deduct. That does not include the salary deferrals made by the employees. So this is the limit on amounts over and above what the employees defer, and these could include matching contributions or profit sharing contributions. But when they're contributed, there is a limit, again, at the individual level, the allocation limit of 100% of pay to a maximum of $50,000. And this does include the salary deferral amounts. So the most anybody could get would be $50,000 in combination with their salary deferrals and any employer money, whether it be matching, profit sharing, qualified non-elective, that goes in and is put into their account. Eligible employees obviously can save here. This allows them to save through salary deferrals, and that money could go in pre-tax. It could also go in after tax. Those are the Roth 401k features. Money will go in after tax, but potentially, if all goes well, be tax-free when it comes out at the other end. Or it could be a combination of both. Most plans that offer both features will allow the employees to split their contribution. They could do some of it pre-tax and some of it after tax if they want to. It can also include employer contributions, which may commonly take the form of a match. Or it could be what's called a non-elective contribution. That's a flat percentage the employer might choose to put in. And the plan could also include discretionary profit-sharing contributions made by the employer. There are several different kinds of 401k plans. You can see them on slide 6 here. There's the traditional 401k. We're all pretty accustomed to that 401k, and we'll talk about that. Safe Harbor 401k, which is a version of 401k that has more restrictions in it that allow the employer, when they meet those requirements, it guarantees that anybody highly compensated can defer the maximum pretty much no matter what. The Solo K, which is the 401k when you only have the owner participating, maybe an owner, sometimes an owner and partner, but certainly no rank and file employees. And then the Roth 401k, which is really just a feature in a 401k enabling the salary deferrals to be made after tax. So what are the features of a 401k plan? Obviously, pre-tax employee salary deferrals. And for those who are age 50 and older, they can also do catch-up contributions over and above the salary deferral limit. It might have Roth 401k deferrals, allowing those same deferrals, but to be done post-tax instead of pre-tax. The optional employer contributions, as we already said. And all the money that goes in will have tax-deferred growth. So clearly the advantage is usually the appeal up front is the tax deduction and the tax-deferred growth as it stays in there. The exception obviously being the Roth pays tax up front, but then everything that comes out at the end will be income tax-free. So who participates? Typically the eligibility will be age 21 with 1 year of service, and that year is a year in which they work 1,000 hours. Now, salary deferrals are always fully vested. They always belong to the participant because they were their pay to begin with. But any employer contributions can be subject to a vesting schedule. Generally, that schedule can range up to 6, sometimes 7 years. And the plans, a traditional 401k is subject to something called the average deferral percentage test. That means that the amounts that the highly paid employees can put in will be controlled It's the actual deferral percentage test which will test the average. What's the average deferral rate of the non-highly compensated employees? And then that is applied to a factor, and that says what percentage on average the highly compensated may defer. We'll come back and talk about that in a minute. The salary deferral limits, one of the changes a few years ago was that it made consistency through all the salary deferral plans. The salary deferral limit for a 401k, 403b, and a 457 is $17,000 a year. For a simple, it is $11,500. These are the 2012 limits. Now, there are catch-up deferrals for those who attain age 50 during the plan year. For someone who's 50 or older, they can do catch-up contributions over and above the regular deferral, and that could be an additional $5,500 in a 401k. In a simple, it's limited. They have lower amounts. That's $2,500. And there is a special rule that you have to be aware of for 403b participants. It's an odd rule, but when someone is in a 403b as well as a 401k, you have to take those salary, or even just a profit sharing, you have to take those salary deferrals made in a 403b into account. Usually the people affected by this are physicians, maybe at a hospital, and it's a quirky rule. Just want to make you aware of it here. Here's my example. Someone's in a 403b. They deferred $16,500, just to pick a number. For some reason, they didn't go to the maximum. You had a profit-sharing contribution in a plan as well. That would be limited so that the combined total did not exceed $50,000. So here's the ADP test. We divide our employees into highly compensated and non-highly compensated. I'm not going to get into that definition now, but basically anybody who's high paid above a certain level will be highly compensated. We take the average deferral for the non-highly compensated group, including those employees who didn't defer. They count as zero, so they're going to draw that percentage down. And then whatever that percentage is, you apply a factor to figure out what the average percentage for the highly compensated group could be. So you can see from the chart here, let's say that the non-highly compensated percentage was 3%. Then the maximum the highly compensated percentage would be 5%. You'd add 2 percentage points. Now, what does this really mean in reality? It means that if you don't get a high enough percentage rate out of your non-highly compensated employees, your rank and file employees, your highly compensated employees will not be able to defer as much as they might want to. Let's take a look at a case study here. We have 2 owners and 2 employees and see what happens here. Now, both our owners here, the 2 highly compensated, make $250,000. Assuming they want to defer the maximum, on slide 14 here, you can see the numbers, that would be $17,000. Now, owner A could also make the catch-up because they're eligible. Owner B isn't 50 yet. Now, $17,000 is 6.8% of their pay. In order to be able to do that, they would have to get a deferral percentage of 4.8% from the rank and file employees. That means employee 1 would have to defer $2,880, and employee 2 would have to defer $1,440. We don't care whether they make a catch-up. That won't play into the test. Now, what would commonly be done, you'd have to ask yourself the question, could you reasonably expect that the employees would defer 4.8% of pay? For most people, that would be considered a rather high percentage. Most employees would not defer that. You could offer a match to try and incent them up. This plan is showing a 3% match. You might actually want to, in this instance, actually move that up to reward 5% of deferral. It all depends on what that employer is willing to spend, what they can afford to spend, and what might work for them. Now, the trade-off would be, here we assume they did get it, even though they only had a 3% match. These employees wanted to save and all was well, and then the employer also put in a profit-sharing contribution to get the 2 owners up to the maximum they could possibly get. But let's say it didn't go as well, and employee 1 didn't defer, or they both deferred but only deferred up to the match of 3%. That means the deferral rate for the 2 owners would be cut back, and they couldn't put in the full $17,000 that they wanted to. So an alternative is to go to safe harbor. Now, what safe harbor means, a safe harbor is that there are rules that have been provided that provide a safe harbor for the plan, meaning that they don't have to worry about this deferral percentage test. The owners and anybody else can defer the maximum regardless of what the employees do. So it eliminates that test. You don't have that worry anymore. You can sit there across the desk from someone who's a highly paid person and say, yes, you can put in the maximum. Absolutely. But the trade-off for that is that there is a mandatory employer contribution, and the mandatory employer contribution is immediately vested once it is made. The employer could still make additional contributions, profit-sharing contributions, and they would go on a regular vesting schedule, but that mandatory contribution is immediately vested. There are two choices as to how they might make that contribution, and they're on slide 16. The employer could match. If it's done as a match, they have to do a 100% match on the first 3% of pay that an employee defers, and 50% of pay on the next 2 percentage points that an employee defers. These are required by the rules. There's no flexibility here. So they're matching up to 5% of pay. The total potential cost for the employer is 4% of payroll. The 100% on the first 3% and 50% on the next 2. Or they could make a 3% flat contribution for everybody instead. This is not a match. Everybody gets the 3%, whether they defer or not. The employer might have preferences from one way or the other. It depends what they want to do with the plan. Now, the advantage if they use the 3% flat rate, if the employer plans to make a profit-sharing contribution as well, that 3% can count towards meeting the requirements of the discrimination testing on the profit-sharing contribution. If the matching option is used, you don't get to do that. So you can see on slide 17 here, we go back to our same group. Now, both our owners are deferring their $17,000. Employee number 1, number 2, we put them as deferring 0. Frankly, it doesn't matter at this point for our testing. Now, owner A also does the catch-up. We do the 3% safe harbor flat requirement, so we're putting in 3% for everybody. And then just making up the difference in the profit sharing to get our 2 owners to the max, but only having to give to the employees the balance of what is required to pass our discrimination testing above that 3%. You can see those amounts are quite small. And this gets us to the final goal for this particular business owner. The owners respectively are receiving 22.2% and 20% of their compensation, and the employees are only getting 4.73%. That's a pretty good leveraging on this plan. Now, another exciting opportunity for the 401ks is the 401k for one. This is a 401k for someone who might be self-employed, doesn't matter whether they're incorporated or not incorporated, but they have no rank and file employees. It becomes a very simple way for them to save. They can save substantial dollars, very minimal administration. They do need a plan document to set this up. Those can be acquired very inexpensively. In fact, no $5,500 for the administration has to be filed until they have $250,000 in assets. But this can create much better leveraging than the SEP would. And here you can see on slide 19, if they had the SEP or a straight profit sharing, they could contribute 25% of pay. For someone making $100,000, that means $25,000. But if they added this 401k feature to it, they could also do a salary deferral on top of that of $17,000. And if they're 50 or older, could also do the catch-up for another $5,500, totaling $47,500. Now, that's a lot to put away on $100,000 of compensation. Now, if this was their only compensation, they might find it hard to live on what was left after they deferred this much. But this is a very popular planning scenario for people who have second sources of income. Maybe they have consulting business on the side, or maybe they have a second business on the side. There are lots of people who fall into this category, and they're living off their primary income but have this secondary source of income, and they would very much like to tax shield as much of it as they can. Now, let's talk about the other piece of when you put in a 401k plan. Let's go back to when you have employees. There are a couple things that have to be done. You need a plan document, obviously creates the plan. But where does the money go? You need a record-keeping system, and that will usually hold the platform. And most people don't really understand what the record-keeping system does. The record-keeping system will hold all the record where all the investments are for each person's individual account. Give that employee access, typically 24 hours a day via a toll-free number and web access. And it has their individual account, shows what their current balance is, what their current status is, gives them a tremendous amount of detail, and also usually allows the employees to go right online, move their investments around if they so choose. There are many, many investment platforms out there to choose from. We work with many of them. So, but it's part of the planned sale, kind of the way the sales process works. You sit down with the employer, propose the 401k, they look at how it's going to play out. Depending on the size of the group, they may be looking for different factors, but you go through all that. The next question is, where is the money going to go? Typically, you then meet with that employer and choose an investment platform. Most of these platforms have hundreds, if not thousands, of funds on them. So there's a great diversity of choice. And then when the plan is set up with the administrator, if you set it up with us, we would work with you. That platform would be set up. We would do the plan documentation, and from there on, do all the plan administration, which is many factors, steps in a 401k. You can see them, some of them on slide 21, to get the plan up and operating and kept in compliance. So we're happy to help you with that process. The investment platforms are not as complicated as they appear. And there are just so many choices. There's great flexibility. And of course, now we have full fee disclosure, so you can actually see, you and the employer can see what those platforms will actually cost. So thank you very much.
Thanks for attending this webinar. If you'd like additional information, please visit our website at abgpentegra.com. You can also reach me via email at mread, that's R-E-A-D, like you read a book, at abgpentegra.com, or you can call me at 802-477-2018. Thank you.